Are you looking to invest in the stock market? Are you a new trader, have time limit restraints? Maybe you just don't know what you're doing yet. Maybe you're uncertain of all the unpredictability in the stock market, or you just want steady growth. Then you're going to want to watch this video on mutual funds. Hello everybody, this video is going to be a very insightful video on explaining what exactly a mutual fund is and how they work. Mutual funds are an often overlooked trading method, especially for new traders. So this video is going to provide all the essential information that investors should know before they actually get involved in mutual funds. So what exactly is a mutual fund? So a mutual fund is a legally pooled amount of money from multiple investors that's actually put into a collection or a basket, they call it, of stocks, meaning multiple stocks in one investment. That's actually run by a particular portfolio manager. So the difference between a mutual fund and a stock is that a stock is a single company that you're investing into, because you're actually pooling money with multiple investors, and that money is going to multiple stocks or commodities. The purpose of this is to ensure for diversity in your portfolio. What that means is diversification of your money pooled with others. It goes into multiple sectors and different companies. The benefit of that is if one of those companies or a couple companies are having down years or down times, those other companies can kind of bail it out. So it really helps new investors especially kind of get their feet wet, get involved. Maybe they want to be hands off of stock trading. They don't have the time to sit there and watch it. If you're a busy person and you really don't want to break down all the numbers, mutual funds can actually be a great opportunity for you. So mutual funds are sort of a hands-off approach. What that means is you're putting in the money, but a portfolio manager, a professional, is actually the one who's going to be deciding what stocks to potentially invest in, or is going to be managing the overall portfolio that's geared towards certain companies or sectors. So there's two types of mutual funds.
So the two types of mutual funds are open-ended and closed-ended funds. Open-ended funds are a majority of mutual funds. Shares are actually created and destroyed as necessary. There's not a fixed number of shares out there. Open-ended mutual funds also go by the net asset value as a guide for how many shares you can obtain of a particular mutual fund. So with the open-ended mutual funds, there's higher risk, higher reward. The managers are typically active. So with the open-ended mutual funds, you typically have higher loads and fees that are attached to that. And it's a more aggressive style and active style of mutual fund. Closed-ended mutual funds are less common than open-ended mutual funds. There's a set amount of shares out there. So it goes off of supply and demand and market value, similar to stock trading. Some of the benefits of a closed-ended mutual fund are lower fees and lower loads. And also you have more consistent payouts, a steady stream of income. You can get quarterly or monthly payouts. In addition to the two types of mutual funds, you also have two different management approaches.
So you have an active mutual fund where the portfolio manager is actively looking for different stock sectors to kind of get into, or different companies, and a little bit more hands-on to the portfolio. A passive portfolio really sticks to the indexes like the Dow Jones and the S&Ps, meaning they kind of are set with certain companies within the Dow or the S&P, and they kind of go as they go. They're steady. The portfolio manager does less active investing. Those are the passive sort of mutual funds, similar to an index fund. So a couple pros to owning a mutual fund: steady growth managed by a professional. You have a lot of good diversification of different sectors. So if one sector goes down or one company goes down, the others can kind of bail it out. Some of the drawbacks from getting into mutual funds is you don't have as much control. So if you're a type A personality and you really want to be investing into all your stocks and doing the analytics, then you're probably not going to want to do too much of mutual funds. There are fees and commissions, which I will explain in just a minute. And essentially it's less risk, but on the flip side, it's less reward. And another drawback to mutual funds is they typically are longer term. So how exactly do mutual funds work? In order to trade mutual funds, you have to have an online broker or a financial advisor who is a broker. So something like TD Ameritrade or Fidelity, those kind of companies offer mutual funds. Robinhood and Webull do not offer mutual funds. One thing you got to know is, depending on the particular mutual fund that you're going to invest in, there are minimums. Most of them are around 0 to 2,500 minimum to invest in. So as long as you're reaching the minimum requirement, you can put whatever amount you want in. So if it's a 0 minimum, you can actually invest into a mutual fund with $1. So the first thing you're probably going to see when looking into mutual funds is the net asset value, which is basically the price and value of the mutual fund divided by the shares that are outstanding or the shares out there. Another thing to know is mutual funds are not actively traded during the day, and the price does not fluctuate as a stock would during the day. Instead, it's at the end of the trading day, after 4 p.m. East Coast time. So if you're looking to buy a particular mutual fund, they will not be filled until after the trading day. So you'd want to check periodically after 4 p.m. to see if your shares got filled to that particular mutual fund. Sometimes mutual funds are full and not open to new investors. You also have to plan on investing for at least 30 days. Now, typically people invest for years in mutual funds. It depends on your strategy and what you're looking to accomplish with the particular mutual fund investment. If you do decide to sell a mutual fund prematurely, there could be a charge for doing that. This is to basically discourage investors from buying and selling mutual funds too quickly, because it does not benefit the investors or the company to get in and get out like you would with a stock. So those companies could actually be hit with capital gains fees, which get passed on to the investors. So less profit for everybody. So they try to discourage quick buying and selling with mutual funds. If you're looking to quickly buy and sell, then you want to do regular stock trading. Let's talk about one of the more confusing aspects of mutual funds, which is all the different fees and commissions and the different types that are out there. You're going to see something like Class A, Class B, Class C, even Class H and I. What the heck do those mean? So as I mentioned before, mutual funds come with fees and commissions. So be prepared for that. That is to pay for the management of the portfolio, the services that you're using, the broker, etc. Sometimes the higher the fees can pay off, but other times not necessarily. It really depends. So there's a lot of misunderstanding of whether the higher fees and commissions will get greater returns. There's no data that says either way officially. You can be very successful in mutual funds with low fees, very little fees at all, or you can also be successful with the bigger ones that have higher fees and commissions. It's really personal preference. And again, when you invest in the stock market, you are taking a risk. There is a little luck involved. We don't know exactly what the future holds. You have to make an educated guess based on everything that's out there. And one of the benefits of a mutual fund is you have professionals who have a lot invested in this that are basically taking care of this. And also you don't have to sell. If things go down, you can simply keep your money invested into those mutual funds until the market rebounds. All right, so one of the more common mutual fund types is a front load. Class A sort of shares based on a mutual fund is where you front load and you pay on the front end when you get into a mutual fund. What that means is they're going to take a percentage of whatever you invest, and you're going to pay that as a fee right off the bat. So for Class B and C mutual funds, they're actually going to take out the fees and the commissions annually or at the end, the back end when you sell. So when you're looking into particular mutual funds, you want to look into what kind of fees they have. You want to look at whether it's a front end Class A mutual fund. You want to look as to whether the Class B or C is a level load payment, meaning that you're going to be charged annually a certain percentage. You also want to look at what the back end of a Class B or a C potential fee is. What you want to do is have a certain duration in mind, and you want to determine whether the fees of a Class A or Class B or C are probably better long term. So let's take a look at an example of how those fees would work out.
All right, for this particular example, we're going to look at BlackRock Tech Share A, which means it's going to be a front load sales commission fee of 5.25%. In addition, there's a 1.18% net expense ratio fee that's due annually. So let's look at how that factors into a $10,000 investment. So if you put $10,000 in, they're going to take out 5.25%, which is $525 right away. In addition, you're going to have the 1.18% annual fee. So that's going to come out to a total of 6.43%, which is $643 off your actual investment. So the first year is $643, and annually there will be approximately $118 plus in fees. Now, just to put it in perspective, this stock last year had a 52% increase. So it did very well. Now, that's not necessarily common. The average mutual fund is around 10% yield. So that's pretty good.
All right, so now let's look at some of the key data or statistics that you would look at when determining a mutual fund.
Okay, for this particular example, we're going to look back at BlackRock Technologies. Just a reminder, this is Class A shares, so that means it's a front load fee. When thinking about particular mutual funds, you first want to look at the prospectus. The prospectus is the official summary that is by the mutual fund itself that gives you all the information you need. So this was the example I did before on Class A shares and all the fees. So this is how they calculate the net expense ratio. Now, most of the time, these websites kind of take the key information from the prospectus and put it into the website so that you can see it. The one thing that grabs my attention outside of the net asset value is the expense ratio. So this is what we're going to pay annually if you stay in this particular mutual fund. This is the front end load that you will pay that I did the example with before. And over here, it tells you what the minimums for the particular mutual funds are. So you want to pay attention to that depending on how much money you have. Another key statistic is the turnover rate. This is how many people buy and sell throughout a particular year within this fund. So this stock has done really well in terms of growth over the past 10 years. I mean, look at last year was a phenomenal year, 2020, for this particular tech mutual fund. The growth over these past 10 years has been pretty good. And you look and you can see it here with the chart. In addition, most websites you can find what stocks are in your mutual fund. So as you can see, there's some pretty blue chip stocks here: Tesla, Apple, Microsoft, etc. So it also has the fund manager information. These are the people who are going to be making the commissions and managing your funds, giving you the returns. And if you look at MarketWatch, they have similar information. It has the fees and expenses. It's got the expense ratio. It also has whether it's an open versus a close-end fund. And as you can see, the 52-week is 52%. Both websites also will have dividend information. This particular mutual fund does not have a dividend. Many of them do have dividends. The alpha and the beta are statistics to determine volatility. Typically, over 1% is a very volatile mutual fund. And here's a chart of going over all the different rankings in terms of the mutual fund that's by MarketWatch. So it's always good to look at a couple different websites and key data to determine what the right mutual fund is for you.
All right, so I hope you found this video informative. I hope it helps answer a lot of questions that you have regarding mutual funds. Mutual funds, as stated before, are a great way to get involved in the market if you don't have the time or the expertise, or you just want to kind of lay back and set it and forget it. So if you're still watching this video, thank you so much for your support. Give me a thumbs up, leave a comment if you have any questions, and don't forget to subscribe. We will see you guys next time. Thank you.